Robinhood and the real risk for financial markets. Robinhood is a legendary outlaw who first appeared in an English folktale in the 13th century. He is best known as the man who steals from the rich to give to the poor. Fintech, or to be more precise, decentralized finance, is allowing an ever larger group of retail investors to trade on Wall Street, just like institutional investors. Robinhood, eToro, Schwab, and others are online brokers that facilitate such retail participation. They are not outlaws that take from the rich to give to the poor, but they are allowing the poor to participate in an activity that in the past was mostly preserved for the rich. Recently, something new has occurred. By using social media groups, retail investors have effectively coordinated their trades. But there is more to it. They have used publicly available data to figure out which institutional investors, mainly hedge funds, had highly leveraged short positions in specific stocks. And so the army of retail investors has bought up those stocks, effectively waging a war against the short sellers, and last week winning their first major battle with Melvin Capital, a hedge fund specialized in short selling, which found itself in need of a bailout after having been forced to close its short sale of GameStop, a troubled chain of video game shops. Of course, GameStop's stock price, which rose by a multiple of almost 30, is no longer based on fundamentals. Then again, nobody knows the exact value of a stock price at any point in time. Bubbles and market frenzies, and yes, market manipulation have always existed, with or without the participation of retail investors. It is now being argued that the current retail frenzy is the proverbial straw that broke the camel's back, that is to say, the trigger for the correction of an overvalued market. But interestingly, the retail army was not making any bet on the market. They were only buying specific and minor stocks that were massively overshorted by a few perfectly greedy and over-leveraged hedge funds. With markets already being technically overbought, and with Europe having its own vaccine rollout mess, the fear that some short sellers might have to liquidate some of their more mainstream market positions was an excellent excuse to sell. But beyond the short market conjectures, it is far more interesting to look at the long-term implications of so-called decentralized finance. The biggest risk for financial markets would be the regulator suddenly starting to intervene by limiting retail investors' options. For if what has always been allowed for the big players suddenly becomes a no-go for the small guy, then I would really become concerned for the future of financial markets as we know them. Better then for all the players to up the ante, let the online brokers recapitalize so that they can accommodate for the settlement of massive participation of retail investors. Let the hedge funds start scraping and analyzing data from the social media platforms, as the better amongst them are already doing, so that they can anticipate buying and selling trends and behave more prudently when applying leverage to certain positions. As for the retail investors themselves, many of them will anyway suffer when fundamentals will set in. They will thus become more prudent too. In sum, technological innovation is allowing decentralized finance and more market participation by more people. Retail investors are not inherently more stupid or more intelligent than the pros. The worst thing the regulator can do is to set up rules that effectively block the development of broader and deeper markets.